My name is Nick Nauta. I am a certified financial planner and owner of Nick Nauta Financial. I'm very excited that we have Craig Godfrey with us today. Craig is a CPA with Godfrey, Wise & Berg and has a wealth of knowledge on tax and health savings accounts. When Craig and I began discussing working together on a webinar, we were both very excited at the possibilities that we're seeing with health savings accounts and how our clients are utilizing them to maximize not only their present tax situation, but also their long-term savings. Today, our goal is to educate you on the tax and long-term savings benefits of health savings account and help you find out if you're eligible to have an account and how you can maximize your current health savings account. First, we want to mention a few quick disclosures that we have today. I am a registered representative of securities offered through Cambridge Investment Research, which is a broker-dealer. I'm also an investment advisor representative of Cambridge Investment Research Advisors. And Nick Nauta Financial and Godfrey, Wise & Berg CPAs and Advisors are not affiliated with Cambridge. So with that, I'd actually like to turn it over to Craig to talk a little bit about the nuts and bolts of what an HSA is and what those benefits are. Craig?
Thanks a lot, Nick. It's great to be here and talk about these HSA accounts. Let's talk about the benefits of health savings accounts to begin with. And you could look at this as really having triple tax savings. One is going to be the contributions to this account are pre-tax, so they're either deductible on your income tax return, or your employer can make contributions to your HSA account and they're not taxable to you. Second, the earnings within the account grow tax deferred or tax free. And withdrawals are tax-free if used to pay for qualified medical expenses. And the tax-deferred situation is where, at any time you can withdraw funds from your HSA account, but if those funds aren't used for qualified medical expenses, they are taxed at your tax rate for the year, plus a 20% penalty over and above what the income taxes are. These accounts, the health savings accounts, are portable, which means that in the event of a job change, if your employer is contributing to the account, unemployment, retirement, relocation, changes in family or marital status, all are situations that do not affect your account anyway. You continue to own your account. The control, as I was saying, you as the account owner have decision-making authority over a few things here: how much to contribute, how much or how the account is invested, which medical expenses the fund should be used for. Any unused balances then, this account is different than a flexible spending account in that these HSA balances, or whatever money you haven't spent in the account by the end of the year, by December 31st, in other words, the balance does not have to be used in full every year. Any unused portion can be rolled over each year. The ownership of the account, again, the account holder is the owner of the account regardless of where the contributions come from. So whether you make the contributions or your employer. Some features of the health savings accounts: contributions. As we've alluded to here, employer contributions are tax deductible by the employer and excluded from the employee's income. Contributions made by an individual are tax deductible. So if your employer makes contributions and you as an individual make contributions to your account, you are able to deduct the amount you paid to your account, not your employer's amount, but your amount on your income tax return. Additional contributions are allowed to be made to the account and deductible if you are age 55 or older. The maximum contribution limits, so for this year, 2016, individual coverage under a high deductible health plan, and that's a very important point. You have to be covered by a high deductible health plan, otherwise you are not eligible for a health savings account. Individual coverage, $3,350 for this year, 2016. If you have family coverage under, again, a high deductible health plan, the maximum that you can deduct and contribute is $6,750. And the catch-up, again, if you're age 55 or older by the end of the year, is $1,000. If we move on to expenses and withdrawals, withdrawals can be tax-free. The funds have to be used for qualified medical expenses, though, and these are defined in Section 213, subsection D of the Internal Revenue Code. Or you could also look at IRS publication 502 for more information. But basically, medical expenses that prescription-wise that are prescribed, those are going to qualify, whereas over-the-counter items will not. The funds in the HSA account can be withdrawn at any time, and qualified expenses after age 65. So you're able to, if you're on Medicare at age 65, the Medicare premiums and, of course, out-of-pocket medical expenses can be paid for. Distributions out of the account after age 65 are not subject to the penalty. They are only subject to income taxes if the funds are not used for qualified medical expenses. So once again, the requirement to participate in an HSA, you must be covered by a qualified high deductible health plan, and your health insurance provider will know whether the plan that you are considering is a high deductible plan and qualifies for an HSA. I'm familiar somewhat with the Blue Cross plans, and they do have certain plans that definitely are HSA, qualify for an HSA account, and other plans that do not. So just ask that question to make sure. You may not have any other medical coverage. You cannot be claimed as a dependent on someone else's tax return. So some strategic planning here before we turn things back over to Nick for some thoughts is using your HSA as an investment vehicle for, as one item, retirement planning. So once someone reaches age 65, distributions from the account for non-medical related items are taxed as normal income, as I mentioned just a minute ago. No mandatory age-related distributions are required. So that means that when you turn 70 and a half, as with IRA or other retirement type accounts, an HSA account does not have a distribution requirement. Long-term care planning, using HSA funds to purchase long-term care insurance. Of course, you're subject to some maximum amounts based on your age for that, so be careful with that. So really, self-insuring through HSA funds is really what you're doing. Beneficiary planning. So spouse can be a designated beneficiary and can treat the HSA as their own. A non-spouse beneficiary account stops being an HSA, and the fair market value is taxable to that beneficiary. There's no penalty associated with it, but it cannot be, or it's not taxable if the beneficiary uses the HSA funds for a decedent's qualifying medical expenses within 1 year of death. And Nick, I'll turn it back over to you.
Thanks, Craig. We've talked a lot about kind of the ins and outs of the HSA plan, and one of the things that Craig and I talked about is really how CPAs love this account for the tax benefits. That pre-tax benefit is outstanding, but also really the after-tax benefits as well. You know, you get a lot of flexibility with the HSA to use it before you're 59 and a half. So when it comes to retirement planning, there's some strategic ways that we can use that for medical expenses, but you can also use it for longer term things. And one of the things that we're noticing is many people think of HSAs as short-term savings accounts where you put money in, you get that pre-tax benefit, and then you can take it out that year if you have medical expenses that incur. And so one of the things that we're doing with our clients is we're starting to look at some of the longer-term benefits. And one major differentiator between an HSA and some of the flexible spending accounts that you see a lot of the employers have is this ability to roll over those funds and really the ability to invest those funds. So not only are you taking advantage of the tax benefits by not having to pay taxes on those contributions, but you're also taking advantage of the tax deferred compound interest, which can be huge. So I'm going to go into a couple of quick ideas that we have, or a couple of quick examples to really kind of show you how clients are using these HSAs to plan for things like retirement and long-term care. So one example is a retirement planning example. So we have Jim and Joni Booth, Jim and Joni, they're both 45 years old and own a small business. So they're maxing out their HSA, which equates to about $562 a month if you do it on a monthly basis. And instead of using those funds for their current medical expenses, they are choosing to roll those funds over and invest them. So if they can get a 7% rate of return over the next 20 years while contributing, if they're in the 25% tax bracket, they're saving about $1,600 a year in taxes, or over the next 20 years about $33,000. So that's the immediate tax benefit. But they're also saving an additional $50,000 on the tax deferred growth that they're getting from the investment. So the future value of their HSA at 65 would be $456,000 that they would then be able to go out and use for medical expenses or any expense. The big differentiator being with some of those other expenses, they'd have to pay the taxes on it. Now, doing a lot of retirement planning, I can tell you, and the statistics are showing that in an average couple's retirement age, you're looking at over $300,000 of medical expenses for a couple who is on Medicare. So you're talking about the Medicare expense, which you can use your HSA funds for. We're talking about the supplemental plans, the out-of-pocket copays, all of that stuff you can use your HSA funds for during retirement. So chances are most people aren't going to have a hard time finding ways to take this money out for medical expenses and not paying taxes on it, but it also gives you the flexibility that you can do both. So you can see that there's a huge savings not only in the short term, but also in the long term when it comes to HSA planning and how we can take advantage of that compound interest, which from the financial planning aspect is probably one of the most important benefits that you can get from an HSA, and not a lot of people are taking advantage of it right now. So the implications, like we said, greater flexibility. You've got the tax qualified retirement health expenses. There isn't any required distributions. So unlike the traditional IRA, you don't have to take out distributions at a certain age. And another planning feature is we can also start to reduce some of your taxable income in retirement. And we'll just touch on this. If you have further questions on it, feel free to shoot me an email and we can talk a little bit about it. But one of the things that we're seeing in the tax world is the Medicare Advantage plans and the Medigap premiums are actually tiered based on, and your Medicare premiums are tiered based on how much income that you have. And so from a planning aspect, if we think you're going to have a large income in retirement, you could actually end up paying more in premium for the same coverage as someone with a lower income. And so with an HSA, we can help reduce that income by taking those tax-free distributions to hopefully keep you under those thresholds where you can actually pay a lower amount in premium for the same coverage. Next example is just a long-term care planning scenario. So we've got Ben and Julie Graham, and they're funding their HSA at age 50. So they're maxing out with the catch-ups and getting an 8 over that 15-year time frame, which leaves them at retirement age with $213,000 of HSA funds. And they stop contributing at that point and let them grow at a little bit more conservative rate of return around the 6% rate until they're age 85. So Ben and Julie decide that they don't need to use those funds for medical expenses in retirement, and they want to fund their long-term care needs for that. So based on those examples, the HSA fund at age 85, which is about where we start to see needing long-term care, there's over $650,000 available so that they can self-fund their long-term care needs. And so one of the benefits of the HSA is a lot of those, if not all of those qualified long-term care expenses can be used coming out tax-free from the health savings account. So it's an example of a couple that wants to kind of self-fund their long-term care needs. If they don't use it, that's great. The surviving spouse is going to be able to take over that account, or their beneficiaries will get that account at that point. So it's not something they lose like traditional long-term care insurance. It's a good chunk of money to have from a long-term care perspective with those ever-increasing prices. Another option at age 65 would be for them to take that $213,000 of HSA funds and actually purchase long-term care insurance. So it's a great planning point to have that discussion around that age of, do we want to buy insurance with these funds? Do we want to continue to let them grow and self-insure? A lot of that will depend on their ability to qualify for long-term care insurance or their comfort level with the long-term care insurance program. So planning implications for this one, like we said, we can self-fund, purchase long-term care. You don't lose it if you don't use it. When you self-insure, that money is going to go to your beneficiaries. Sure, there's going to be a tax bill associated with that, but if anybody wants to give me $600,000, but I have to pay taxes on it, it's definitely something that I would be happy to accept. If you're looking for more information on what those expenses are, you can go to publication 502, and they will show you exactly what those qualified long-term care services are. You can also shoot Craig or myself an email, and we can help you plan those. Another nice thing is that you don't have those required distributions. So if you have years where you don't have medical expenses, you don't have to take a certain amount out, which really helps you protect those long-term or those funds for long-term care expenses. So if you have any questions, shoot us a note in the chat box, or you can always email myself or Craig. I don't see any questions so far. So some of the next steps, if you're looking to start an HSA and start investing, you can contact me. My email is up on the screen. You can also visit our website. I put out a couple of blog pieces on health savings accounts and health planning and retirement in general. So if you're looking for more information, that's a great place to start. If you have questions on the taxable aspects of health savings account and your eligibility or how to use those in your tax plan, you're going to want to contact Craig or visit their website to take a look at that information. We are here to help, and hopefully you have found this educational, and we hope that you learned something today. Craig, you got anything else for us?
No, through our website, they can also sign up for our monthly newsletter also.
Perfect.
And we thank you for attending.
Yes, thank you.